We are all familiar with that rule of investing, which says that you should buy a stock when the PE is low, which means the earnings are there but the market is not paying enough for it, and sell it when the PE is high because the risks are high at that point. But there's a category of stocks for which this rule actually gets inverted, and which is the cyclical industries like cement, steel, etc. Because these are industries which have a cycle. There are times when the demand is very good, prices of your output are booming, your profits are very good, and then there is a time when there is overcapacity, prices are sluggish, your profits are not that great. So in such industries you want to go in when the cycle is going up and get out just past the peak. But when you, let's say you make a decision that now this commodity is going to start doing well, usually it is at a time when the previous period earnings for that sector or those companies are not very good. So the PE actually looks high, but that is when you want to get into that stock. Whereas once that boom time comes and you know that boom is peaking and now the prices will start to decline, prices of the product and therefore later on of the stock also, at that time often the reported PE looks very low because the earnings have been very good in the recent past, except that they are not sustainable. So you, in general, because you want to catch the boom and bust cycle of the commodity, the right time to buy those stocks often is when the PE is high, and the right time to sell is when the PE is low. So that is an inversion of the general rule, but it is worth keeping in mind.